Most homeowners don't refinance because it's a good financial decision. They refinance because a lender told them it made sense, or because the payment looked a little better, or in some cases because they felt like they might miss their chance. And years later, they realized they made a mistake. They reset their mortgage, they paid thousands in fees they didn't fully understand, or in some cases they pulled equity out without realizing what it would actually cost them long term. That's why today is truly Refinance 101. This is not a video about chasing the lowest rate. It's not about predictions. And it's definitely not about refinancing just because you can. This is about understanding how refinancing actually works, when it makes sense, when it doesn't, and what you need to watch out for so you don't make a bad decision. Because refinancing can be a powerful tool, but when it's done wrong, it quietly costs people tens of thousands of dollars. If you're even thinking about refinancing your mortgage, this is a video you need to watch all the way through. One reason this topic is coming up more often right now is that mortgage rates are meaningfully lower than they were this time last year. They moved from about 7.25% to around 6% this year. And they didn't move in a straight line, and it wasn't necessarily consistent, but it was enough to get people's attention again. And wherever rates move, homeowners start asking the same questions. Should I refinance now? Does it finally make sense? Or should I wait because rates might go even lower? So here's what you need to understand. Rates do not move in a straight line. They move up, they move down, sometimes they move sideways, and sometimes it can happen very quickly. And even if rates go lower in the future, that does not mean you will automatically be able to refinance later. You can have income changes, you can have credit changes, you can have equity changes, in some cases, guideline changes. So this decision cannot be based on hope or predictions, it has to be based on math. Now, before we talk about what a refinance actually is, I'd like to take a minute and ask a favor. If you find any value in my videos, make sure you hit that thumbs up, and please consider subscribing to the channel to stay updated on everything real estate and mortgage related. So a refinance is not a modification. It's not a tweak. It's not an adjustment. A refinance is a full replacement of your existing mortgage with a brand new loan. That means a new interest rate, a new term, a new amortization schedule, and new cost. That new loan might improve your situation. It might also quietly cost you far more than you realize. That's why refinancing is never automatically good or bad. It's situational. Now let's take a minute and talk about the only reasons refinancing should even be considered, in my opinion. If your reason for refinancing does not fall into one of these categories, you probably need to pause. The first one is lowering your monthly payment, but only if the math works. This is where most people start, and this is where most people mess it up. Lowering your payment sounds great, but the payment alone means nothing without context. Let's walk through this slowly. Say a lender tells you you can save $200 a month by refinancing. In your head, that sounds like a win. Now ask the question most people never ask. What did it cost me to get that $200 per month? Let's say the total cost to refinance is $5,000. You need to take that $500,000 and divide it by $200. That equals roughly 25 months. That means it takes just over 2 years before you ever break even. So the real question is not whether the payment is lower. The real question is whether you are confident you'll keep that loan longer than 25 months. If the answer is yes, refinancing might make sense. If the answer is no, or I'm not sure, then it probably doesn't. So let's say, for example, you're one of those people that you're thinking you might sell in the next 2 years. Then that's one of those reasons you might pause. Also, if you're one of those people chasing the lowest rate constantly, if you think interest rates might continue to move down in the near future and there might be another opportunity for you to refinance, and if they do move down, you're going to take advantage of them, then you probably want to limit that cost as much as possible and have your break-even point as short as possible. Now let's look at a more common scenario. Let's say that you're being told you'll save $100 per month, but the refinance might cost you, say, $6,000. Then divide $6,000 by the 100, that's going to equal roughly 60 months. That's 5 years just to get your money back. And here's the part that most people miss. If you are already years into your mortgage and you reset it back to a brand new 30-year fixed loan, that matters. Because guess what? You're now starting back at the beginning. Lowering your payment by $75 or $100 a month can feel good short term, but it can quietly cost you tens of thousands of dollars long term. Payment relief is not free. Break even is the decision. So now I want to talk about no-cost refinances and why that term is misleading. Now, this is something you'll hear constantly, that there's no cost to refinance. In fact, when you got your original loan, you might have been told by that lender, hey, if you come back to me, I'll do a no-cost refinance for you. In your head, you're thinking, hey, I'll be able to refinance and there's absolutely no fees involved. But that's the problem, because when they say that, that usually means one of two things. The costs are baked into a higher interest rate, or the costs are added to your loan balance. So you are still paying, you're just paying it differently. Anytime someone tells you a refinance is no cost, the right follow-up question is simple. Where are the costs being hidden? As many of you know, I was able to refinance my loan twice back in 2024. Both times, I did it without any cost out of pocket and without adding it to my loan balance. The way I was able to do that is I was able to take a slightly higher interest rate than the best rate out there in the market, and the lender was able to give me a credit to cover that cost. So in that case, yes, I was able to have a no-cost refinance, but I was able to get that by taking a higher interest rate than the best rate out there. So it's very, very important to understand the context when someone says free. On top of that, I want to talk about why I don't like paying points or buying down the rate when refinancing. I want to be very, very clear here. I am not a fan of paying points or buying down the rate in most situations, especially if you believe rates may move lower again. Paying points means you are giving the lender more money up front to get a lower rate. That in itself increases your refinance costs. Let's say your refinance costs $5,000 without points. With points, it might cost $9,000, and paying those points might save you an extra $75 a month. That extra $4,000 divided by 75 is 53 months. That's over 4 years just to recover the cost of points. And that assumes you keep the loan that long, never refinance again, and rates don't improve. If rates drop and you refinance again in 2 years, those points are gone. And the reason for that is because it's a sunk cost. You're never able to recover that money. I would much rather keep my cash, take a slightly higher interest rate, and preserve flexibility, because flexibility has value. Now, in some cases, paying points may make sense. If you're at the end of your working career and you think going forward there's a possibility that you might not be able to qualify for another refinance, even if interest rates move lower, then that might be an opportunity for you to pay points and take the lowest rate possible. But for the majority of people out there, paying points, in my opinion, is not the right move. The second time you might consider refinancing your mortgage is if you're able to remove mortgage insurance. This is one of the most overlooked opportunities. If you're currently paying PMI on a conventional loan or mortgage insurance on an FHA loan, you are not just paying interest. You're also paying an insurance premium every single month. Let's say your mortgage insurance is $250 per month. That's $3,000 per year. If refinancing allows you to remove that insurance and it costs you $4,500 to refinance, here's the math. $4,500 divided by 250 equals 18 months. That's a much faster break even. That is why refinancing to remove mortgage insurance can make sense even when rates don't look dramatically better on paper. The third reason is cash out refinancing, but only with discipline and a plan. Cash out refinancing can be very, very useful, but it can also be the most dangerous option. Let's say you pull $50,000 out to pay off credit card debt. Before the refinance, you're paying, say, $1,000 a month in debt payments. After the refinance, your mortgage payment goes up $250, but the debt payments are gone. Your net savings are $750 a month. In that case, that can make sense, but only if you do not run the debt back up. What I see all the time is people refinance, pay off the debt, extend their loan, and then end up right back in debt again. Now, in that case, the mortgage is higher and the debt is back. In my opinion, that's not strategy, that's a reset button. Equity should be used intentionally, not emotionally. And the fourth reason you might consider a refinance is changing your loan structure for stability, not hype. Sometimes refinancing isn't about saving money today, it's about reducing risk. Examples include moving from an adjustable rate mortgage to a fixed rate loan, shortening the loan term, or switching loan types for long-term flexibility. These decisions still need to pass the same break-even test. So a lot of people always ask, how do I know when I should consider refinancing? Well, my lender has something called a $125,000 screening formula. It's a quick filter you can use before you ever call a lender. What you do is you take $125,000 and you divide it into your current loan balance. The result is roughly how much your rate needs to drop for a no-point refinance to actually make sense. So if you owe $250,000, you need about 0.5% in improvement. If you owe $500,000, you need about 0.25%. If you owe roughly $1 million, you need about 0.1%. Now understand, this is not a rule, it's just a screening tool. And before you go through this formula and try to figure it out on your own, what I would advise is make sure you speak to a professional in the business that understands refinancing, can answer these questions, and actually guide you through that process. If you're watching this, you're not sure where to start, we help hundreds of people here on YouTube, and we'd love the opportunity to help you too. You can actually get in touch with me and my team using that link in the description. Now I want to take a minute here and talk about FHA loans, because FHA loans get a very bad rap because of the mortgage insurance that FHA loans have. So a lot of people think, well, I have an FHA loan, I want to refinance because rates have moved down and I want to get rid of this mortgage insurance. But what most people don't understand is that FHA rates are a lot lower typically than conventional rates. So the blended rate between the FHA rate and that mortgage insurance is typically lower than most conventional loans out there. So if you have an FHA loan, you need to understand this because it's critical. Your real rate is not just your interest rate. It's your interest rate plus your mortgage insurance. So a 5% FHA rate with 0.85% mortgage insurance is really a 5.85% effective rate. So I often hear a lot of people with FHA loans that have 3.5% interest rates that have that 0.85% mortgage insurance. So they have a blended rate of say 3.85, or in some cases, if they have a 3.5% rate with that 0.85 mortgage insurance, they have a 4.35% interest rate. And they're thinking, I got to refinance. I got to get rid of this mortgage insurance, without understanding that their blended rate is still much lower than any rate offered in the market today. And that's the number you need to compare when you're evaluating refinance options. Now let's talk about shopping lenders the right way. The two groups of people who get burned the most are the ones who take the first quote and the ones who talk to 10 lenders and don't know how to compare them. All you need is 2 to 3 solid quotes close together in time is usually enough. And for mortgage purposes, you typically have a 45-day window where multiple credit pulls count as a single inquiry. Shopping correctly is not what hurts people. Not understanding the numbers is. So with that, you need to understand how to read a loan estimate. If you want to protect yourself, look at box A on the loan estimate. That's where the lender fees live. Not taxes, not insurance, not prepaid items. This is the easiest way to compare lenders, apples to apples. If one lender is dramatically better or worse than the rest, that's a red flag. So you need to look at box A on the loan estimate and look at what those fees are. Add them together. That's essentially your cost for doing that loan. It doesn't matter what they're called. They can be called discount points. They can be called origination points. They can be called processing fees. Any sort of thing added in there. It doesn't matter what it's called. That's a fee that you're paying in order to get that loan. So if you want to compare lenders, apples to apples, you need to look at box A on the loan estimate. Oftentimes we'll get people calling and they're getting offered a dramatically better interest rate than something our team can offer out there. And then when you look at box A on the loan estimate, you realize that they're paying 1, 2, 3 points in order to get that interest rate. And many times that borrower had no idea. So just understand, when you're talking to a lender and you're getting quotes, not only are you paying attention to the interest rate, but you're also paying attention to box A as well as box J on that, because in some cases that lender might be giving you a credit back to offset some of that cost. But if you're watching this and you're confused, you're not sure what to look at, you want us to review an estimate that you have, just use that link in the description. So now I started this video by calling it a Refinance 101. So now I want to talk about what the process actually looks like. The very first thing you're going to do is have an initial conversation where the lender should ask you why you're refinancing and how long you plan to keep the home. Next is going to come the application and document collection, then the loan estimate review, then the appraisal in most cases, unless you have an FHA loan or a VA loan, because in those you're able to do what's called a streamline, which doesn't require an appraisal and typically doesn't require any sort of documentation. And then once you have all of that, your loan's going to go to underwriting where everything is verified. And then finally, closing. So ideally from start to finish, a refinance should probably take somewhere between 3 to 4 weeks. But here's where I see people get burned. People get burned because they focus on rate instead of math, payment instead of break even, and marketing instead of numbers. Now, in my opinion, most people don't need someone to sell them a refinance. Rather, they need someone to tell them when not to do one. Our job is simple. Run the numbers, explain the trade-offs, protect you from bad decisions. Sometimes that means moving forward. Sometimes that means walking away. Either way, you should know exactly why. The process of refinancing is typically pretty simple, but sometimes understanding the math, understanding, what a lender's charging you, whether or not they're resetting your loan, what it's actually costing you to get there, can be very complicated. So if you don't understand the cost, the break even, and the process, you're going to be taking unnecessary risks. So if you want help doing this the right way, that's exactly what my team does. Make sure you reach out using that link in the description.